Hello everyone, welcome to another episode of Returns Weekly. Apologies for this one being a few days late. I only sent out the newsletter on Sunday, and so it's taken me a couple of days since then to get around to recording it. Let's get on to the matter at hand. So I'll just share my screen. So I've had quite a few people sign up to the newsletter in the last couple of weeks, so I kind of thought it would be timely maybe just to give another quick overview of firm returns and the 3 different newsletters that I provide, and also for people that are interested, give some stats on how many newsletter subscribers I have and other such things. So do that first, then we're going to get on to some updates with some of the portfolio companies, specifically TMI, the Taylor Maritime Investments, Warner Bros. Discovery, and TinyBuild. And no, the TinyBuild update is not to do with the equity raise. So apologies if you're waiting for news on that. I'm still waiting too. Yeah, let's have a look. So first off, these Firm Returns Weekly newsletters, which is what I'm basing this episode of this audio episode on, provide ongoing coverage of the companies I hold in my portfolio, namely Ecora Resources, Warner Bros. Discovery, TinyBuild, Taylor Maritime Investments, Fuller Smith & Turner, and Aviva. In addition, you will from time to time see segments on general investing thoughts, as I did before, talking about the Bill Nygren interviews and so on. And I'll probably start adding in coverage of companies on my watch list that I'm actively tracking. So if I do generally, I think it's going to be companies that I've done a write-up on. But if I'm planning to do some more write-ups in the new year, and I'll probably, if they're companies that I'm considering getting a position in or I liked or something like that, I might, once I've done the initial write-up, provide some ongoing coverage, keep following them, and then be looking and getting to know them a bit more and waiting for maybe an entry point if I do want to add them to my portfolio, or maybe they're rotating in with something else or as something comes out or something like that. So yeah, that's the weekly newsletter, which, like I say, it's largely following the portfolio companies, as anybody following these videos will know. But there's some other sort of bits and pieces I'm planning to sort of start working in, maybe particularly on weeks where there's not been that much news, though it's been pretty news heavy for the last few months. But on certain weeks, there might be a topic that I think there's only a couple of bits of news or less than 1 or 2 bits of news. And so I think, this would be maybe an opportune time to do some in general investing thoughts, or maybe to discuss something else I'm actively tracking, that's on my watch list, considering maybe a shallow dive or something if it's a company that I've not done a in-depth article on. But yeah, that's the weekly newsletter. And then separately, you'll receive portfolio updates when I buy or sell shares, and deeper stock analysis on individual companies. And I've said it's admittedly been quite a while since I've done a write-up on a new company. I think the last one was Ecora Resources, technically. It's the last sort of fresh write-up, and I think that was back in May. So after I went to the AGM, I did a write-up on it. So I've written up everything that's in my portfolio, so you can find write-ups, and I think put links here on most of these to the write-ups I've done. So you can go find in-depth write-ups on all of those. But yeah, I want to start doing some more, finding the time to do some more write-ups on new companies, because I think I really need to be expanding my horizons, and personally as well, I'd like to expand my portfolio out with a few more names, and I'd like to keep analyzing new companies. So some of them might be competitors to companies in my existing portfolio. So there's a bit of competitor analysis should help with deciding, help with conviction on the companies I own and so on, and ongoing due diligence. And then there'll be other examples of its new sectors I've not looked at before. So I'm thinking about looking at Jet2, which is an airline based in the UK and listed on the AIM market. And then DSW Capital is another one that's probably going to be the first one I do, which is like a small accounting services, financial services firm. So it's kind of a bit of a franchise model that's quite interesting to have a look at. So I'm going to do that one probably first. And there's quite a few other companies on the list. So you should start hopefully seeing some of those coming out. And they're not necessarily going to be ones that I'm definitely going to add to my portfolio. So this is I'm just going to more routinely do in-depth write-ups on new companies. So then I've got a more conviction in my watch list as well. So I've actually read it if I'm tracking them so on. It can other things that can add to the weekly stuff, and it's also stuff that if an opportunity comes along, I can pounce and actually make an investment. I don't need to wait several months for me to do the due diligence first before doing it. So it's all companies that I think are going to be relatively interesting investment opportunities. Right, and then some stats. So Firm Returns now has 425 members. I think it's actually 427 as of today. So I've had a couple more sign-ups in the last couple of days. And more than 200 people read the newsletter every week, which is incredible. I was really, when I first started it back at the end of, I think it was in November of 2022, I'd done some write-ups before that when I really started this site, the newsletter in its current form and so on, was in November. And before that, I did have I kind of put some of I had a couple of write-ups I put online, but it wasn't in a newsletter form that was sent out or anything like that. Yeah, I thought maybe I'll shoot to see if I can get 100 people by the end of the year, and obviously 425, and I have more than 200 people that read every week, routinely. So it's really good. I mean, the overall open rate for the newsletter is consistently above 60%, which is pretty high, I understand. And it can get up into the 70s when I do new write-ups. So obviously it gives me some incentive to try and do new ones. You guys prefer new stuff as well. Though, well, I think the weekly updates, the weekly newsletters have been well received, and it's a way of me putting out more regular content and keeping people engaged. But yeah, if I put out a new article on a new company, or I do a big update on something like the more recent tiny board update that I covered, that kind of gets up into, I can get up into the 70s, which is phenomenal. And then there are obviously people that tune in for the topic, the companies they're interested in. So I've got some people that are only interested in eCoral Resources, for instance, or only interested in Warner Bros. Discovery, and so they'll just open those particular ones. But in the main, there's a good body of sort of 200 people or more that read every week, which is amazing. But yeah, so yeah, I've kind of set myself the goal of trying to get. So I'm not so concerned about the top line figure of 427 now, but I'd like to try and get it to a stage just as an ambition, considering how far beyond my prior expectations I managed to get in the last year. See if I can hit a regular reader base of 500. So that would be like 100 it would 150% increase from here in terms of the regular weekly readers if we're getting over 200 at the moment. So let's just say a double. But yeah, so that's kind of like, see if I can do that, but I don't know. We'll see. It's really going to depend on how many, because I think most of the growth in the newsletter has come from when I've done new write-ups generally. So the weekly stuff is good for engagement, and it has a good open rate of the existing subscribers, but it doesn't really draw many new people. I get like a little trickle, just a continuous trickle of people coming in over the weeks and so on. But the real like big inflows come when I do a new write-up and publicize it a bit and stuff like that on social media and things. So yeah, that's gonna be the way. If I want to hit that target, I'm gonna have to do it. It's doing more of the fresh write-ups. But yeah, so that's kind of on me to see if I can do that. So yeah, let's get on to the main topics of the week anyway. So having a look at Taylor Maritime investments first. We've had the half-year report being published this week. So it covers the 6 months ending the 30th of September 2023. So we obviously have got quite a bit of the headline kind of information from the quarterly trading updates they've done, which I've covered in past episodes and so on. But this really obviously gives you a lot more depth. It gives you like a proper financial accounts and everything like that. So you can really, I've dug into it and pulled out some key bits. And the first of these was the investment performance. So, and they give a quite a helpful table here. So as highlighted in the table, gross operating profit has fallen substantially despite a larger combined fleet, reflecting the impact of lower charter rates in the period. Finance costs have also seen a substantial rise as a result of higher interest rates and the debt taken on to fund the Grindrod acquisition. These costs provide plenty of impetus for the deleveraging the company, which management has been doing aggressively. I'm not too concerned by the loss in capital values, which is just a largely an artifact of timing for the valuations. As the day which they've obviously done this valuation, which I guess would have been 30th of September, it's pretty close to the trough they had in August. So it's and most of the recovery in charter rates and valuations has happened since then in October, November, and into December. So yeah, when we see the next trading update, I'm kind of expecting these to have rebounded, as we've seen with charter rates. So I think they're now they're over 900 now. The index. So yeah, it was 862, actually 872 on the 8th of December, and it's now up to 900. I think it went up to 909 or something, and it's kind of settled down a bit to 903 or something like that now. Kind of hit a entry temporary or plateaued a bit anyway. It's hit a bit of a peak. But yeah, you can just see on this table here. So the original 6 months back in 2022 was, I think, would have been before the Grindrod acquisition. So, and well, they kind of had a slice of it, which is why they've got the dividend income here. I think that'll be why. But it's largely just the TMI fleet, which was larger at that time. The actual TMI fleet, they've sold off some more vessels, but now with the acquisition of Grindrod, it's kind of the overall combined fleet is now larger, as evidenced by the total vessel days here. So it's gone from 5,109 days to 9,312 days. But you can see the TMI group's actually gone from 5,109 down to 3,989. And then you've got the net charter revenue, which has gone up, but the operating expenses, because that's now with a larger group, the operating expenses have gone up by more. and so the gross profit has come down. And another big thing here, which I've highlighted in red, is the finance costs have rocketed up from $3.83 million to $20.37 million. So big increase in the effectively interest expense being paid here in the first 6 months. And then the loss in capital values, as I said, was largely a paper loss, though obviously the fact that they're having to or sell vessels now for the in order to pay down the debt means that they are going to be solidifying this loss, capitalizing this loss. But generally, the vessels that have been sold have, as you can look back, they've generated returns in excess of their cost bases, so the actual amount they paid for them originally. Even though these capital values have come down on these vessels, they're still above the price they originally paid, so they're still making a profit on them. So yeah, it's not quite as bad as this figure. Made out to believe they just had a very big rise in the prior years when rates really rocketed up, and now are coming back down to earth to more reasonable levels. The group expenses, this line here is actually, they've increased by about $1 million, some from 4 million to 5 million, and I think that's largely increased travel expenses from what I saw. So they weren't able to travel as much in 2022 in the first 6 months there because of all the COVID stuff, and they're now doing more traveling. I guess they've been doing a fair bit with the fact that they were acquiring Grindrod and managing things and so on, and now with the CEO of TMI also becoming the CEO, and I think other members of the executive team managing Grindrod, there's more, travel duties there, I'd expect, as a result, and integrating all the teams together and all the rest of it. But yeah, so it obviously wouldn't have been, they wouldn't, even if you took away the finance costs, wound them back down to the same level as before, then there would have been enough gross operating profit from the group to pay the dividend, even after subtracting the group expenses. So the dividend, I think, is about $16 million, something like that, $16-17 million. So they would have had enough to pay that. Maybe that's a bit higher than that. Maybe it's 13 or 14 million. But anyway, even if you take away the 5 million and let's say another 3 or 4 million from that, it still would be enough to cover it. So it's not horrendous level. It obviously just shows the necessity to pay down the debt, but give some, I'll get onto that a bit. But yeah, obviously, if they're selling vessels to pay off the debt, and their net charter revenue is going to decrease as well, as they're losing some of on the basis of losing total vessel days or capacity there. So the next thing I pulled out was an interesting little nugget in the financial covenants on their new debt facility. So there is a minimum liquidity requirement for them to hold at least $5 million plus an additional $250,000 per vessel owned or bareboat chartered by TMI. With this info in mind, we can look at the table of assets and liabilities included in the additional information section of the report and see that much of the cash required by these covenants is held in the individual SPVs for each vessel. So here I've shown the special purpose vehicles, SPVs, here all listed for TMI. Good Falkirk here is what they're holding the grind rod investment in. So that's why it's 304 million, and all the others are, the largest of the others is 28 million. But yeah, you can see with the others, so the investments in securities and other, so yeah, you can see in all the individual SPVs, which each one is going to hold an individual vessel. These are down. So vessels at fair value through profit loss and other assets. You've got the fair values of the vessels here on the first column, and then you've got the other assets here in the middle column. And I'm pretty sure this is mostly cash, because amongst all of these, there has to be at least $5 million for the debt covenants, plus 250,000 per vessel. So I think each individual SPV, pretty much, with the exception of this one, that's just below 250,000. It's probably got the minimum 250k required to meet their liquidity requirement for the debt covenant, and then you've got sort of excess across the whole group to make up the overall 5 million. Plus, I guess it's also going to include the cash at hand at the parent level. But in total, there's $11,445,806 in other net assets. So, like I say, I think a lot of this is just going to be cash held in all these individual SPVs. And obviously, they don't have to pay any tax on these because they're all companies registered in the Marshall Islands. So, very tax efficient way of doing things. Another good find in the additional information section was the following table detailing the dividend cover calculation. So here you can see the true cash flow they're generating from operations, as well as the cash cost of debt, interest, and docking capital expenditure, fleet maintenance expense. They have notably been able to reduce the docking capital expenditure in the first half of 23 versus the first half of 22. This could suggest that non-essential work was done the prior year to enhance the fleet, or that they've postponed maintenance expenditure this year. In any case, we can see that the fleet didn't generate enough cash in the first 6 months of the financial year to cover the dividend, even excluding interest expense. So yeah, we can see here. So in the prior year, their adjusted TMI EBITDA, inclusive of the underlying SPVs, was $60.43 million, and this year it's fallen to $11.97 million. So quite a drop in those, and across those two periods, showing you the difference there in the charter rates. And the interest expense has gone from $3.43 million to 13.2. Now, if we go up, I think it was like 12.87 finance. Yeah, kind of roughly in line to the TMI group, similar kind of finance expense there. So not quite the same, but they are roughly in line with those finance costs we saw in the investment performance table. But yeah, this interest expense was, and combined with the docking capital expenditure as well, was, so that has come down significantly. So it was $11.78 million in 2022, and it's now come down to $3 million. So this could be that maybe they were including, like, adding those boss cap fins and various other enhancement work they were doing on the vessels to make them more efficient stuff, and they've sort of postponed, or maybe it's all the stuff that's been done, or they're postponing some of these optional enhancement things until they've got a better cash flow situation, prioritizing debt repayments on, or maybe they're postponing fleet maintenance, which may be slightly more questionable. But I think of what I've heard, they sort of dry dock the boats on at least a 2 yearly cycle anyway. So maybe this is just the year that they're all synchronized. So it doesn't quite make sense that they would have them all synchronized to take out in the same at the same time. So I think it would be one if they staggered them over a couple of years would probably be better, just in terms of fleet utilization and everything. It'd be longer. Well, there'd be a smaller number of the overall fleet taken out of action any one time. So maybe it is a case of some of them being pushed back even further than 2 years or something. But anyway, we'll have to see how that develops in future reports. But in any case, even if you took away the interest expense, the adjusted TMI EBITDA, inclusive of the underlying SPVs, wouldn't have been enough to cover the dividend, which was 13.2. So it was 30. Yeah, the dividend, when I was saying 16 or whatever, it was actually about 13. I misremembered that. I think it was 6 point something or other was the bit that I was remembering, and I was adding a 1 to the front. But anyway, so yeah, it's whereas last year it was covered 3.6 times. So yeah, it's a good table, this, and I think it really shows you how much they're actually spend after you take away just the cash flow, net cash flow from the fleet coming in, and then you take away the sort of the capex they happen to do. It really lays this out nicely, and it's not something that's particularly clear from the IFRS financial statements because of the complex corporate structure, having all these SPVs and stuff like that. It kind of just makes it look, it's hard to say what your cash flow from operations, all that kind of stuff is, because the operations are actually way down in their own special purpose vehicles. So yeah, this is a particularly good table to pull out of the notes in the additional information section. So yeah, I'll just put a little point here as well that I hope these sort of 3 examples I've given here show the first one wasn't in the notes, but show the importance of reading the notes to the financial statements, because there's, especially with companies that have some complex corporate structure to them, which, to be honest, is a lot of companies. Since they get past a certain size, they have subsidiaries and all sorts of things as well that can complicate some of the accounting and different segments and things. So reading the notes to the financial statements is a really crucial for doing your analysis on companies, and there's lots of good information to pull out there that the management provides for you. So yeah, you can answer a lot of questions. So yeah, there's also a post-period trading update they provided. This was more in the RNS regulatory news service bulletin that was put out announcing the release of this half-year report. That was where most of this information was, rather than actually embedded in the report itself. But yeah, it's pretty positive. So the company is starting to lock in some significantly higher charter rates in the last month or so. And here's what they said. So dry bulk rates accelerated from mid-November before surging at the end of the month, with the adjusted BHSI TCA time charter average rising to $12,967 per day, and the adjusted BSI, so BHSI is Baltic Handysize Index and BSI is Baltic Supramax, but also includes Ultramax, I think, index. So the 2 different size vessels they have, rising to $16,715, which is 121 and 124% respectively above their mid-August low points. So that was, and it is quite a big jump from the time the vessel valuations were done and so on as well. The company subsequently agreed medium-term charters for 3 TMI handy-sized vessels, a $16,000 per day gross time charter rate for 100 to 150 days, a $19,000 per day gross time charter rate for 75 days, and a $13,000 per day gross time charter rate for 100 to 150 days. So these are really positive. I mean, that 19,000 one is pretty incredible as well. And 60, yeah, overall, all of them are above the current average, and they're locked in for at least 2 months. Some of them, well, 150 is like 5 months. So 4 to 5 months. So yeah, it's really good to be seeing that. And they're looking to sort of try and, I think, straddle what can often be weaker, sort of the Chinese New Year period. And sort of Christmas period can be a little bit softer. So they're looking to sort of straddle that. So this is a very welcome development that should allow the company to continue its debt repayment without needing to sell as many vessels. And those it does sell are likely to command higher prices than just a few months ago. So yeah, it's definitely a positive development for the company, and comes at a great time. So the other bit of news for TMI beyond the half-year report was that they've had a couple of board changes. So we also heard this week that Charles Maltby will be appointed as the non-executive director of the company from the 1st of January 2024. Charles has served on the board of Grindrod since the 6th of December 2022 and will be resigning from this post on the 31st of December 2023. Helen Tveitan, sorry if I'm mispronouncing your name there, will also be retiring from the TMI board on the 31st of March 2024. So board size will be the same. This Charles Maltby guy is going to be coming across from Grindrod. So some representation from the prior board. But he was only there for a pretty limited time. But he's from, I think he's got a pretty big history. I think he was the CEO of Epic Bolsan or something like that, which is like one of the world's largest LNG transporters or companies, something like that, crazy. And then also has some crossover with some of the prior companies that some of the TMI people have worked in. So yeah, there's some links there, but yeah, that's like a pretty good appointment. So yeah, moving on to Warner Bros. Discovery. We heard this week that they have just signed a podcast deal with Spotify. This will include CNN's All There Is with Anderson Cooper, The Assignment with Audie Cornish, and HBO's The Official Game of Thrones podcast, House of the Dragon. This is in addition to a multi-year deal they have with Spotify to create podcasts from DC Comics. So there's been quite a lot of stuff. They've had, so they're doing this partnership with Spotify, doing licensing deals with, I've heard, with quite a few things with Amazon and with Netflix and so on. So yeah, we're in a pretty good. They're doing quite a bit of collaborations and partnerships and so on with other companies. So it's kind of good to see, and hopefully monetizing more of their content through some of their competitors as well, rather than just purely trying to grow their own platform at all costs, doing it steadily over time, and while still getting as much funding as they can out of other shows. Yeah, I think there's certain shows that they've been sitting there and they've had a certain amount of viewing, but they get put onto something like Netflix or whatever, or Amazon, and they get a brand new sort of like audience, and that hadn't signed up to Max before or whatever, and suddenly are all viewing this content, and so they can get obviously rates, the license fees are linked to how many views and so on they get, so they can actually make quite a bit more perhaps than they would have done holding it just purely exclusively on their own platform, from like advertising linked revenue and so on, which would be linked by the views and so on as well. So the other bit of news from Warner Bros. Discovery is about Wonka, the movie that released released about a week earlier in some international markets like the UK and some European ones, Germany as well, I think, and some other places. But it had its opening weekend in the US last weekend, and it had a strong start with gross revenue of $39 million in the US, and it's currently clocked in $151.4 million globally, and this is set against a production budget of $125 million. So it's looking like this film could turn a pretty tidy profit if it maintains its current trajectory. And I think, let's see if this will end, but they give a pretty good graph here showing the trajectory here is pretty much in line with films that just the domestic box office did comfortably over 100 million domestically. So yeah, it's looking pretty positive. Pretty steep trajectory on one of the steepest in this a good early start. This is a comparison between holiday season musicals. So musicals all came out around about Christmas time. So positive, looking like that could be a good result, and I think it's got had good ratings all around from what I've seen as well. So finally, I just wanted to give a quick update on TinyBuild. So we're still waiting on news of the equity raise, as I said at the top. But in the meantime, I wanted to share a positive update on Deadside. So on Thursday, the 14th of December, the developers released version 0.10.0, which includes a major map expansion with a large new city, which you can see here in the picture. It's not the best. There's a better one potentially I think we're on top of this building. You've got a really great panoramic view over the whole city vista and so on. So it includes a major map expansion with a large new city called Kamensk, along with notable improvements to game performance and AI. So the update has generated a lot of engagement, with peak concurrent player numbers hitting a 12-month peak of 2,218 on Saturday. And I think the last update before that was probably the last peak before that was within the last 12 months was when they released the boats, I think. Or maybe at least it's when they added the first vehicle to the game, basically. I think that was back in like April or May times, on those lines. Or maybe March, earlier on in the year anyway. And so, yeah, we now surpassed that peak, set a new record for the year. And it's seen a significant jump in the positive reviews on the game's Steam store page in the last few days as well. So on the day, I think, of the release, we had this big 40 positive reviews come in. And overall, it's been trending positive. And it had so sales and so on had run up a bit because they'd had a discount applied, a publisher sale running till something like the 16th, I think. So that did overlap a little bit with the start of the launch. So that did help with those sales, but it's still held up. I mean, with this update coming out, I think it's held up pretty well, even though the sale ended. It's still around about still in the top 500 selling games on Steam. So it's still selling pretty well. Selling significantly higher than just the baseline sort of level of Graveyard Keeper right now, for instance. So, which is often a popular one of the top selling TinyBuild games just across the board, and now continuing to do it now at full price. So, though it did get down into like the 200s or something when this sale was on as well and everything. So, but yeah, still in a good place. So, yeah. So I also tested the update out with a friend on Friday evening on a server at full capacity, which was 50 players. And can genuinely say that I was impressed with what they've done. So the new map area is great and really helps the game feel less crowded when the server is full. So previously, sometimes if you had a really full server, you'd end up going to missions and especially anywhere near the safe zones, and you'd have lots of other players turning up to the mission at the same time as you, or they'd already got there first because you were on foot and they had a boat or something or whatever, and you end up just competing to get in, just to complete missions and so on. And didn't really feel like there was enough for everybody sometimes. Whereas now we've just with this, we went to the new area of the map, and obviously there was quite a lot of people there. It was like 5 or 6 people just in that one region, where we were and so on when we visited there. But yeah, it's a long way. It takes about an hour to run there from the safe zone. So it's a pretty serious commitment to get out there, which means that once people are kind of filled up their inventories and so on, then they need to go back to the safe zone. Then until people get bases built up there and stuff like that, then maybe it'll be a bit different. But yeah, it's kind of means that you've got this. It really does feel like it's really expanded. I mean, when we were going to and from we went from the safe zone to the new city area and so on, and did some missions and so on there. Yeah, and yeah, we were doing the missions there, and there was another couple of people who joined the missions or whatever, but they'd kind of filled up their inventories and stuff anyway because they'd been there for a while, and so you could just pick it. You didn't really have to compete for the mission rewards and things like that. They were just, there's plenty to go around and so on. But then when we were sort of coming back and stuff like that, we went to other areas. We just had our pick of missions. We just turn up, do any difficulty mission we wanted, hard ones, whatever, which often draw quite a lot of people, medium missions and stuff. And we were the only ones doing it. We didn't have anybody turn up, and yeah, it felt we did pass people at different points and so on. Like I say, we went to some certain points of interest and around the safe zones and stuff that you see a lot more. There's 50 people online, obviously. But yeah, it really did feel less crowded, which I think the game's are really starting to reach this size, which is kind of crazy because I think it was 25 square kilometers or something before they did this expansion. So it was already still massive. But because people do cluster to the mission areas and stuff like that and around the safe zones, yeah, anyway, I'm going on here, but yeah, I definitely felt that effect, that it was feeling less crowded. And we weren't competing so much to get to do missions. And also the AI and performance improvements were really easily visible. So definitely felt much more performant. It just felt very fluid, the game. And it's felt very good in the past, but this time just a noticeable difference because they had to, in order to get the city, which is now this massive area, they have to sort of render in something to run on people's machines and so on. They had to do some real performance improvements, and then that's just applied to the whole game. Those same things have helped the game to feel smoother everywhere you are on the map. So it's great. And the AI wise, they're much more human-like now, and even like the animals and so on as well have been improved to make them much more realistic in the way they interact with you and so on and respond to you and stuff. So yeah, it's great. It felt a much better experience. Yeah, so I think this game continues to have a lot of potential, and I definitely look forward to seeing where it goes from here. And the fact we're still, able to get these new peaks when they get updates, so it shows there's still a lot of interest in it. And as it progresses over the next year or two towards its version 1.0 release, I think, I could really see the player base growing, and people that have sort of put it on hold, having put in a decent number of hours in the past and so on, coming back for these new updates and so on that they do. And as the game becomes more fleshed out and stuff. So yeah, really good. And we'll just have to wait and see what happens with this equity raise. But anyway, yeah, I think that's pretty much everything for this week. So I will see you all next week. Thanks everyone for watching. and yeah, try and maybe share it around. Help me to get it'd be great to try and grow. I've talked about at the top the subscribers to my newsletter, but it'd be great to grow the YouTube subscribers as well. So, please like, comment, share, etc. Would be great. All right. And yeah, anybody who hasn't signed up to the newsletter, please do that as well. It's entirely free. You can, if you don't want to hear the portfolio updates, you can turn those off. You can just have the weekly updates and get these in written form, and they come before the videos, so a faster news source as well. And then you've got the portfolio, so you've got the stock analysis, which will be coming out as well. You should get those in your inbox. Anyway, yeah, until next time, I'll say goodbye.